China's B-share markets remain closed today after last night's major market opening announcement. But China-linked shares in Hong Kong are powering ahead. On optimism, Beijing's market reforms are accelerating as it gears up to enter the World Trade Organization. China says it will allow Chinese investors to trade hard currency B-shares legally for the first time. That could unleash millions of local investors into a market previously officially reserved for foreigners. The H-share index of Chinese companies listed in Hong Kong is riding on the back of that positive news today. It hit its highest level in November 9th last year. H-share index is up almost 15% since the start of the year, making it one of the best performing indices in Asia this year. Let's take a look at the H-share index right now. Presently up 3.8% at 426. For more on the regulations governing China's B-shares and movements in the H-share market in Hong Kong, we're joined by Philip Chan, Research Director at Shenwan Securities. Philip is in Hong Kong studios. Philip, thank you very much for joining us today. Philip, should we get overly optimistic about China's move?
No, we should get optimistic. It's a good move for the for the markets, because they have to realign the structure of the local stock markets, because there are too many classes of shares, and the B shares have been a problem area for some time now, for several years. This is a good way for them to at least get interest back into those shares, because the locals have been sort of trading those stocks anyway, circumventing the official regulations, and now the government is just basically opening up the markets officially.
Hi there. This is Lisa in the newsroom along with Christine. Do you think that
the
move announced yesterday, hi there, do you think it will eventually result in the integration of the A, B, and H share markets in China?
Well, I think merger of A and B shares is not. I don't think that's going to happen very soon. I think that they're just going to do it step by step. They're just going to allow the local investors to invest in the B shares, let the valuation gap, the valuation differential close, because as you know, there's big gaps in the valuations. For investing in H shares, I think that's further out. I don't think that's on the cards yet. But of course, sentiment is affecting the H shares today, so expect those to just continue for the time being.
Of an impact if domestic investors are allowed to go into the B-share market. I was reading reports this morning that 80% of investing in B-shares is actually done by domestic investors through loopholes.
Yes, that's right. And for Shanghai, that's been the case for the last, particularly so for the last year. In Shenzhen, it's less so. I think it's approximately 60% of the shares are maybe controlled by local investors in Shenzhen, probably because of the ways for trading. It's more difficult for local investors to do so. But although a lot of the trading, day-to-day trading, is actually affected by locals now, it doesn't mean to say that there's a new sort of step up for the markets with this official announcement from the CSRC.
Philip, this will certainly add liquidity into the markets. Does this mean that you would rather still play the H shares in Hong Kong rather than go directly and invest in B shares?
No, we see recommending the B shares is only really for speculation. A lot of the quality of the B shares, for the majority of them, is either poor to mediocre. I mean, at best. There are some good quality B shares there, but there's few. For the H shares, it's variable quality. There's some good quality ones. If you're talking about institutional monies, then they're not going to be going into the B shares in a big way. The H shares they would be looking at, and even so, they're going to be very selective.
Okay, Philip, thank you very much for joining us today. Philip Chan, Research Director at Shenwan Securities, joining us from Hong Kong.